You get euphoric by just swapping it's because it's easy. And companies make billions of dollars from our bad decisions. This is a life-changing thing.
Nearly half of older Americans aged 50 and up carry a balance on their credit card month to month, according to AARP.
The average credit card rate for people who roll over debt month to month is 20%. This is a huge amount of money that they're paying in interest on these credit cards. If you're paying down these credit cards or paying off credit cards, it's so hard to set aside money for retirement. So that's a real problem. And a lot of these folks are relying on their credit cards to pay day-to-day living expenses.
Welcome to Finance Unfiltered, the show where we break those financial myths. We are just going to tell you the truth, how it is. I'm the Dean.
And I'm the Doc.
There's always a debate. And the debate is credit a tool or is it something that's keeping you stuck?
So I always like to kind of focus on perspective because how you see things is how it's going to impact you, right? If you see it as a way where you can get over, you're going to abuse it. If you see it as a tool to help you, right, you're going to be able to use it the right way. And I think for me, from my perspective, credit is simply a tool. It's not a way for you to overspend. If you think about how it was originally established, right, it was established as a way to give people opportunity to get access to business opportunities, right, before they had the actual cash available to them. So, but over time, it evolved. And now people are using it as a way, as quote unquote emergency fund. Credit is not an emergency fund. It's just a way for you to be able to have quick access to be able to access opportunities in the event that you are waiting for some cash to come in. But you have to be very wise in how you use it and how you apply it.
Unfortunately, for many people, they weren't taught about credit, right? So credit was kind of one of those things that they learned about through trial and error.
Yeah.
And, they did not understand. And it's interesting because even though, modern day credit is a newer concept, it's been credit from back in the bartering days where local merchants were just basically be able to extend you kind of like a tab, and you had to pay that before they would extend you anything further. But what happened was that businesses wanted a way to be able to gauge everybody. Right? Standardize it, make it something that everybody can have. And then that's when the Fair Isaac Corporation came up with the FICO.
1989.
But what does credit impact?
I think over time, it impacts more things because everybody wants safety, right? Remember, if I'm a creditor, I'm extending you credit and trusting that eventually you're going to pay that back to me, right? But in order for me to be able to extend it, I have to figure out, can I trust you or not? And I don't know you from a can of paint, right? So I have to have a way to be able to judge whether I can trust you or not, right? Those three numbers make a huge deal, right? Now, before, okay, if I want to go get a loan, get a mortgage loan, get a credit card, get a car, okay, I need to get verified for them to check. Now, even employers are checking your credit to see how, I guess, trustworthy you are. Just think about that. You might have the smarts and the brilliance and the education to be able to get a job, but something as small as three numbers can prevent you from getting that job. Because why? Employers are now looking to see, man, can we trust this person, right? Even your utility companies are using credit to determine how much deposit you got to put down. It happened to me when I was trying to get, my water bill or Pepco, whatever it is. I'm like, what? You got to check credit? Yeah, they check credit to figure out how much you got to put down. And the more credit worthy you are, the less you got to put down because they know you're going to pay your what? Utility bills, right? Now think about it. Like even just business. If you own a business and you're trying to grow the business, right? You want to get more money. Business requires money. How do you get it? You got to get qualified for that, right? They check your credit. And oftentimes, when you're a new person and you don't have any history, although you may be trustworthy, they may not extend that credit to you because why? There's no history for them to base their decision on.
It's like you said, not only does it impact your employment
Yeah.
opportunities. It also impacts your insurance, right?
Yes.
Our insurance
Yes.
companies are now checking credit as a part of their process to fix
Yes.
your insurance premiums.
Yes.
But I
Yes.
think one of the biggest things that it does impact is going to be your interest rates.
Your credit score is one of the ways lenders decide how trustworthy you are as a borrower. But how else can your credit affect you? Here are the top 3 ways your credit score can affect you in real life. Number 1, getting a better interest rate. When applying for a loan or even a new credit card, your credit will be run as part of the approval process. If you're approved, the rate offered will depend on your credit score. The higher your score, the lower the interest rate. Number 2, refinancing loans. Refinancing can help you save money on your monthly payments. Because it requires getting approved for a new loan, your credit score can not only impact the rate offered, but can also affect the type of loan available for you. Number 3, paying for insurance. In some states, insurance companies may run your credit before deciding your premium. A history of punctual payments shows you're a better risk, and this may help you qualify for lower premiums.
All people nowadays need credit. You need
Yeah.
credit to do just about anything. You need
Yeah.
credit just to rent a car. You need
Yeah.
credit. You need credit for everything. But it's really going to impact how much money you pay over time.
Absolutely.
So the person that has the great credit score, the good credit score, versus the person that has the poor credit score is going to end up paying more over time for the exact same obligation.
We mentioned all the ways that credit can impact you. But to me, none more severe than getting a mortgage because for most of us, is the biggest ticket item, that we carry on our day to day, right? Now think about getting let's just say, for example, a house that costs $100,000. If my credit is poor, let's just say in the 500s, let's just say the lender charges me
You ain't getting a
10%
house.
interest,
The credit is in the five.
right?
You're
10%
not
interest
getting a
on,
house.
on that 100,000. But the Dean credit score, let's just say 750 to 800 or above. And they charge the same on the same $100,000 mortgage. They give her a 2% rate. Do you understand in that same 30-year period how much more money I'm gonna pay more than the Dean
Mhm.
just because of that credit score? So we're not talking
Absolutely.
about some small thing here. This is a major, major component of our everyday life. And I think a lot of times we tend to take it for granted and we don't really understand the profundity of having a good credit, right? We kind of think, oh, is this a kind of a medal or a badge? No, this is a life-changing thing. So it behooves all of us to make sure that we take it very seriously and really sit down and figure out how we can improve our credit. You can't say, oh, I got a high 600. That high 600 over the course of a lifetime can cost you hundreds of thousands of dollars compared to somebody who has, something in the upper sevens and the eights. So we can't really take it for granted. It's a huge deal.
Nowadays, because of the economy,
Yes.
wage stagnation,
Stagnation. Absolutely. Yeah.
inflation being at an
Yes.
all-time high,
Yes.
people aren't using their credit as responsibly as maybe they were
Before.
previously.
Yeah.
And it's because many people have turned to, as I said in the clip,
Yeah.
credit to for their everyday expenses, just to buy groceries and put
Yeah.
gas in their car. And there
Yeah.
was a time where credit was predominantly used for those, those desires that you couldn't necessarily afford. Maybe you charged a vacation and you paid for it throughout the year, or
Yeah.
something of that nature. But now people are using credit just to pay their utility bills.
It's very subtle, right? You go to the store. Why do you think credit cards were created? It's not just, oh, let's find an easier way. Everything is to play on our mental, and everything is to play on our psyche. Think about it. If you go to the store to go buy a grocery, to go to dinner, to wherever else, what is easier to use? Pulling out cash out of your pocket and breaking that $50, $100 bill, or just taking that credit card and just swiping it. You get euphoric by just swiping the. It's because it's easy, right? It's by design. Companies make billions of dollars from our bad decisions. Now, as you mentioned, Dean, right, about where we are in the economy, we're right, with wage stagnation, with people not being able to, find jobs. with interest rates being so high on everything, right? People have been pushed into a corner where they're not making enough money, so they don't have any other alternative but to turn to their credit cards, right? That's why credit cards debt is at an all-time high. We took about $1.23 trillion in credit card debt. The average household income has over $16,000 of credit card debt, right? And it's only going to continue to grow as the economy gets tighter and tighter, right? So this is why having an emergency account is so important. As advisors, we preach having an emergency account because why? For times as this, because you can't control when an emergency is going to happen, right? But you got to make sure you're prepared for it, right? Because if you don't, you're going to go further and further into credit card debt. But don't forget, these are not small interest debt. The average credit card debt is over 25-30%.
Yeah.
Imagine having a 30,000 credit card debt paying 25-30%. You will never pay that credit card, especially as most people pay the bare minimum on that payment. Once again, that's by design, because the longer you take to pay anybody, the more money you're going to pay that person. So it's really, this conversation that we're having is one of the most vital conversations that you can ever have in any area of your financial journey.
With the advancement of modern day credit, people have really lost that personal responsibility to save and invest on their own, and they feel like credit is just going to save them. In many cases, it can actually also be a downfall if things happen to just turn. If there's one job loss, one paycheck that doesn't come in, if there's, one economic crisis. I know with the US just lost our last AAA bond rating, where that's a big deal. That means that, other countries are now looking at us as if we're not going to pay our obligations. And bond rates directly impact interest rates and inflation rates, right? So because the money that we get from US bonds is actually how the government, another form of raising revenue for the government. So all of that is going to be impacted. And all of that is going to have a major impact on what people are feeling on their day to day. So I read that loans are actually at the highest point of default. That people are defaulting on just about everything. And credit cards are the first thing that people default on. If they have to have a choice between their car, their mortgage, and their credit card, which one do you think they're going to choose first?
Credit card, definitely.
That credit card. That credit card payment is going to be the first payment that goes into default. And then it's the car, and then of course the home is last. So it's very vital to understand what makes up your credit score. What is a FICO score? What makes up your credit score? And we're going to spend some time talking about that today. Okay.
If you look at your credit score, it's a range of 300 to 850. What are the components that are inside of that score, right? The credit payment history. Because that is what they're using to see how well have you been making payments over the course of time, or however long you've had credit. Do you have good or do you have bad? That is 35% of that score. So if you look at an 850 credit score, 35% is based on your payment history. That is a major factor, and that's the most important factor. The next one, the credit utilization, that shows the lenders how risky you are as a borrower, right? If you have a credit of, let's just say, $10,000 of credit limit, right, and you've used 9,000 of that credit limit, you appear to be extremely risky. So if you then go to another lender to go borrow credit, they may not extend you credit because why? You appear very risky. Now, compared to your friend that has the same credit limit, let's just say $1,000 credit limit, right? And they've only used $200 of that credit limit. If they go to another lender to go borrow more credit, that lender is more liable, it's more amenable to give them a new credit because why? They appear to be a less riskier borrower. So that credit utilization is the next critical component of that, what makes up that credit profile.
And it's important, Doc, to note that one missed payment
Oh
on
man,
your credit history
yeah,
can impact your credit for
significantly.
years,
Oh,
six
even
to
50, 50,
seven
50
years,
points,
right?
easy. Yeah. The three remaining components, right? We're talking about length of credit history. Me, let's just say I have a 5 year history of having credit, whether good or bad, right? But you, out of nowhere, brand new, don't have any history, and we go to borrow money, right? Although my history may not be all that great, I may get approved faster than you having zero history because you appear to be way more risky, right, to the lender than I am. Because at least I've demonstrated certain ability to pay or not to pay on my debts, right? But they have no idea about, right? So you appear more risky. The longer your history, the better, right? And that's why I always advise people, don't just run to cut up your credit cards. Now, if you have a bad history with credit, then that may be a different case. But if you have a decent credit history, right, don't go and cut up your credit cards. You can put them away, hide them somewhere where it's very hard for you to get it. Because why? Those longer history helps you to be able to have better scores because it shows a longer track record, right? As
Absolutely.
compared to new credit, right? And that's 15% of the total credit profile.
Typically, what I encourage is that they freeze them. I tell them to get a
Correct.
Tupperware bowl
Yep.
and fill it up with water and put the credit card in a Tupperware bowl and put it in the freezer. And if
Yeah.
you are going chiseling away at your at your credit card for a pair of shoes, you
That's
may
right.
need to reevaluate some things, right? But in a true
Yeah.
emergency, it'll still be there for you to be able to access it.
Yeah.
And you're absolutely right about payment history and the length of time that
Yeah.
a person has credit, that length of credit, which is
Yeah.
why it's important for us when we have children to help them establish credit as young
Right.
adults.
Yeah.
There are ways you can do it, adding your kids as an authorized user on your account, and helping them to build up that length of time. Now, you only want to do this if you have good credit. You don't want to mess your kids' credit up
Correct.
by adding them as an authorized user to your jacked up
Correct.
credit. But if you have a great credit history already, this can actually in turn help set them up in the beginning of their life for a great credit history,
Absolutely.
by you being able to help them with that length of credit, that credit utilization, and all of the factors that we've talked about so far.
Yes.
So
Yep.
let's talk about the last two factors. The
Yep.
last
Really
factor
quickly.
is going to be new credit, right?
Yep.
So this is going to be you applying for new things. So those hard inquiries in a short period of time.
Yeah.
Now, I've heard that if you're shopping around for something, for instance, an auto loan, and I know
Mm-hmm.
most of us were taught, hey, don't you don't want to apply for too many things at one time.
Mm.
But when you talk about an auto loan, if you're shopping in that time window of, let's say, just a couple of days,
15 days. Yeah, 15 days for them to count all as one pull. Yeah.
as one, that's right. So they'll
Yeah.
be able to shop around and
Yeah.
say, okay, that won't be all counted as multiple hard inquiries.
Correct.
And hard inquiries do stay on your credit report. I think it's 3 years.
Yeah, about
And
24 to 36. Yeah, 36 months. Yeah.
yeah, 24 to 36 months. And it
But
can,
as time progresses, the impact goes lower and lower.
goes down.
Yeah.
Absolutely. So as they get closer to falling off, the
That's
impact
right.
kind of goes away.
That's
So
right.
hard
Yep.
inquiries in a short window can actually lower your score. And then the last category is going to be credit mix, which makes up
Mm-hmm.
10% of your credit.
Yeah.
And that's having various different credit aspects. So not
Correct.
just having all credit cards. Maybe you have a car loan, maybe you have student loans, you might have a mortgage, personal loans, but having a mix of different types of credit impacts your score up to 10%.
That credit mix is very, very important. You might have 700 credit score, but if it's all credit cards, you may not necessarily get approved for a mortgage loan, right? But somebody that might have, let's just say, 680, but they have a good mix, they might get approved before you. They've demonstrated that they can handle different types of loans.
And the whole purpose of this episode is to help you all really understand credit and why it's
Yes.
important to use it responsibly.
Right.
And, it's unfortunate, but again, many people weren't taught. So what happens is that we can use credit irresponsibly. And there are a lot of pressures, especially social pressures, that kind of can cause you to use credit. I mean, if
Yeah.
you look on IG, everybody traveling, everybody in the plane, everybody wheels up, right? So if
Yes.
if that's all you see, what do you think your inclination is to do?
But one thing I want to say, and this is very, very important, right? The credit score is not just a three-digit number that you can just throw out there, right? It's truly a reflection of your financial habits. It's a reflection of how disciplined you are, right? It's also a reflection of how reliable you are. And sometimes you may kind of overlook it, but it really, really portrays a picture of who you are as a person. So if you care about who you are, if you care about how you present, right, you really want to make sure that you take the time and the effort to really tighten up your credit, because that three-digit number literally can either open doors or it can close doors. It can either cost you hundreds of thousands of dollars or it can save you hundreds of thousands of dollars. It's really up to you and what you like to achieve.
I just want to encourage everyone with online shopping, even just going to the gas station, there is a lot of credit card fraud.
Mm.
There are scammers out there waiting to steal your credit card,
Oh
steal
yeah,
your
definitely.
identity, rack up bills in your name. I was working with a client on their finances, and in the process, we found out that they actually had bought a house in Texas, but they hadn't bought a
They
house
don't
in
live in
Texas. They
Texas.
don't live in Texas. Okay, they live here in
That's
Maryland. So,
crazy.
you know, there is an important. You can get ID theft protection,
Yeah.
where it actually can cover you up to $1 million in protection, depending on the amount.
Hmm.
Depending on the coverage, that's going to cover you in the event of someone stealing your identity, or taking credit, opening up credit that's not yours. Things like that. So I encourage you, usually for 10, $11, you can get ID theft protection to
Yeah.
help protect you, and it'll let you know when new credit is open, if your passwords and stuff have been in any breaches,
Hmm.
like all kinds of things, and give you up to $1 million in protection. So using credit wisely, understanding what you should use credit for and what it's
Hmm.
designed for, and making sure that credit does not replace your responsibility to save and invest yourself. You need to invest for yourself, your emergency fund, your retirement, everything else you need to do yourself. So please don't allow credit to replace those
Yeah.
actions. We thank you so much for hopping in today, listening to us. We hope that you got some value out of this episode, because it's about making informed decisions.
That's
Being
right.
able to understand credit allows us to use it more responsibly, and
That's
also
right.
be able to pass that information on to our children and our neighbors and our
That's right.
friends and all of that. So it's really a movement here at
Yeah.
Finance Unfiltered, where
Yes.
we are looking to empower people with financial literacy, financial information, break down those myths, and make sure you get the advice you need. We
That's
are
right.
financial advisors, but we are not your advisor. So if you need
That's right.
specific financial advice, feel free to reach out to your advisor. You can also reach out to us. We
That's
thank
right.
you so much for taking the time out of your afternoon to tune in with us. And until next time,
Deuces. Be safe
peace.
out there, all right?